Once again, you're very welcome to today's free live webinar at HFM Nigeria. You're welcome, you're welcome, you're welcome. My name is Heritage Adisa, and today we're talking about, trends, practically how to look at exactly what is going on in the market, the direction that the market is going, and how you can position yourself to go about trading it, right? There's a very popular saying in trading that goes, "Oh, the trend is your friend." The idea is when price is consistently going higher, moving higher, right? Of course, you want to be moving in that direction, right? When price is going constantly lower, the idea is you want to also be moving in that direction. That is selling when prices are going down and buying when prices are going up. But also, the idea that you want to buy when prices are going up, right? Could also be a challenge because there's a particular, important principle in trading that even if you're buying when you see that prices are clearly going up, you still want to buy at a lower price, right? The fact that price is going down doesn't mean you just jump in and sell. No. If you want to sell, yes, you've identified that price is going down and you want to sell. Fantastic. But you look for a higher price to sell from. So combining buying when the trend is going up and selling when the trend is going down with buying at a lower price or selling at a higher price has to come together for us to find the best possible entries in the market when we trade. And that's why today's topic is interesting because it not only shows us what or helps us identify what the trend is, the uses of moving averages, which is a major tool that a lot of traders get to use, and of course the Fibonacci retracement tool, right? It not only highlights those things, it also shows us overall what exactly we should be doing with these tools when we get them. Now, very quickly, let me just start with moving averages. Now, what exactly is a moving average? In very simple terms, I'm going to cross over to my chart and show you what I'm referring to, right? In very simple terms, moving averages are simply more like an average. Think about it as an average of overall pricing. So price has been going up consistently for a period, depending on what period you select. It basically sums up the numbers and divides it, right? More like taking the average of the price. So price has gone from 0 to 5, right? Right. What's the average of that? Take note of it. There's a line there. Price has gone from 5 to 7. What's the average of that? And as these averages are being taken note of, right, a line joins them together, basically highlighting what it is, right? Exactly highlighting what it is. So the idea is, as a trader, you can use this moving average to see clearly, filter out the noise, right, in the market, filter out the noise, and you're able to see consistently the average, whether prices are clearly moving higher or clearly moving lower. That's the whole idea. It's an indicator in the market that helps you smooth out price data, right? Price, if you look at a price chart like what I have on my screen, you will notice that we have a lot of whipsaw movement here and there, right? Price went up, went down, went up, went down, went up, went down, went up, went down. We have a lot of that, right? So I think the moving average is one of the ways where you could basically smooth out all of these moves and see clearly if prices are have been going up or have been going down, right? It consistently smooths out the price action. What price has been doing, the candles that we can see, it smooths it entirely out. And it also helps us to establish the trend, right? By creating a constant updated average in the price. So the idea is as price continues to change, whatever the new average is, it keeps taking notes of it. It keeps taking notes of it. It keeps taking notes of it till eventually you can see it. So instead of looking at this, it's possible that somebody looks at this and may not be able to tell clearly what the trend is. But of course, a moving average can smooth out all these ups and downs, tops and bottoms, and show you clearly if it's going up and down. It looks something like this. On a price chart, it looks something like this, like a line like this. The idea is this line is basically showing you what the average price is on that particular instrument. Now, in terms of where you find it on the trading platform, right? On your computer like this, if you go to insert, on a computer like this, if you go to insert and you go to indicators, right? Typically, there's quite a number of indicators under different classes, but you'll find moving averages under trends. On the trends. And right there, you can find moving average right here. On the trends, you can find moving average, right? Now, for the moving average, a key thing to also take note of, there are different types of moving averages, right? There are different types of moving averages, right? It depends on what you're trying to look out for. It depends on, you know, how you're paying attention to it, right? If you look at the method, you have the simple moving average, you have the exponential moving average, you have the smooth moving average, and of course, you have the linear weighted moving average. I think the most common ones are the simple and exponential, right? Just to make sure you understand it, just to give you a little bit of clarity on that particular area. The one that says simple moving average is a moving average that basically gives the equal, importance to all of them. The idea is it simply adds up all the price movements and divides by the total number of average. Just the normal average that you have, the normal one, right? The normal prices, the normal average, where it accumulates all the numbers, and of course it divides it by the average number. It's a normal one. But you see, the one that we go as exponential is different in the sense that it puts more importance to recent price action than past price action, right? So let's say we have a series of numbers 1 to 10. The normal average would add 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and divide it by 10. That's a normal simple moving average. So it adds up all the prices, all the average prices, right? And divides by the total number that we have. But you see, the exponential would now put more importance on the later numbers, like 10, like 9, like 8, like 7, put greater importance on it. So whatever is happening on the latest, data in the set carries a lot more, reflects more in the average that you're seeing. So the idea is the exponential moving average basically shows or is closer to what the current price is doing rather than the simple moving average. Now, how do you use, which one do you use? For me, I really use simple most of the time if I need the moving average, because I'm not really particular about the exact number. I just need to know the overall, direction, or use support the moving average as more like an area for support and resistance. So that's how I look at it. But of course, as a trader, you could decide to look at it in a different way. If you want to be sophisticated with it, you can try to use the exponential, apply to the closing price or to the opening price. It depends. The part that says apply here talks about the price, right? How do you want to calculate it? So, for example, this particular candle right now that we have, if you have it on close, let me zoom this in a bit. This latest candle, for example, if you have the moving average, right, on close, for example, let's say we're using the simple moving average, just keep things simple today, and then of course apply to the close, means the closing price. So that means that on the closing price of that particular candle, this last candle, the closing price is what we're going to work with, and we're going to keep dividing by the rest of it. And that's really how it works on that particular one. Now, of course, people can change it to use the open price, the highest price, the lowest price, but I simply don't change this. I leave it at the close. I don't change it at all. I leave it at the close. Now, the one that says period here talks about for how many, I will call it candles now in this case. You see, when it comes to moving averages too, right, the time frames are also important. Right now, I am moving off to the 1 hour time frame right now. And when I'm on a 1 hour time frame, what it's telling me is every single candle bar right now represents an hour each. So this is the current hour now from 12 o'clock to around 1 p.m., the current hour. The previous one was around 11 to 12. 10 to 11, 9 to 10, 8 to 9, 7 to 8, 6 to 7, 5 to 6, and so on and so forth, right? If I move on to a daily time frame, for example, this becomes per day. This is today. This is yesterday. This, of course, is Wednesday. This was Tuesday. This was Monday. If I move to a weekly time frame, it becomes per week. And you can go on and on and on. For example, pounds JPY has been going up steadily since the first week in April. Right? We can see that because all of these have been weekly moves. Weekly. Now, the point is, when we talk about periods on the moving averages, we're talking about how many, candles are you trying to calculate it for? That's the idea. Right? When we talk about periods here, we're talking about how many candles. So do you want to check for, in this case, 1 hour, 50 hours, 50 candles? Or you want to check for 100 candles, 100 hours? Or you want to check for 200 candles or 200 hours because I'm on a 1 hour time frame? But if it's 200 here on the 1 hour time frame, it's for 200 hours. If I move to a daily time frame and I still have 200 here, it becomes for 200 days. So it is based on the period, that's the time frame that you have right there. Now, what period do we use? You see, it depends on different traders, different strategies, different traders use different things, right? To measure moving averages. The momentum strategy, for example, that we use at HFM as well, right, has a lot to do with the 50 simple moving average as well. It has a lot to do with 50. We like to use 50 as well, right? Particularly if you're a day trader. A swing trader can decide to up his own to 100, right? Or maybe even more in some cases. But for the simplicity in this class, we're just going to use 50 simple moving average and we're going to set this. Right? Remember, I didn't really change anything. I simply just, decided what period I want to use. This is everybody's personal choice. It depends on what you're trying to do. But as a general rule, using the 50 for short-term trades, medium day trades, right? I think it works well. And of course, if you're looking at a more long-term or swing trade, using the higher moving averages, in some cases, 100. For some other strategies, you can hit 200. It depends on what you're trying to do. But for this our class, we're going to use 50. And of course, the method isn't simple to keep things just straightforward like that. Now, it depends on how sophisticated you want to go with it. The basic way to use it is using simple. For some people, they can decide to modify this a bit to add other methods to it, exponential, linear, and so on and so forth. And of course, we're not changing what price it applies to, which is the closing price. We're not changing that. So we have that. You could also change the color because for some people, they could also use different moving averages. So they can combine 2 or 3 moving averages and of course use different colors for it. Right. And of course, you could decide to change how thick you want the line to be, right? Basically, how thick you want the line to be, or if you want the line to be dotted or whatever method it is that you want to use. So the idea is just to basically, set it up to the way you want it. And as a simple way to use it for a day trader, you could start with a 50 moving average. And of course, for swing traders, of course, they can increase that. Now, it doesn't mean that that's the only moving averages that you can use. You could change it, depends on what you're looking for. You could adjust accordingly, but the use remains the same 100%. So let's just quickly do that. And then we say, okay, I'm just going to zoom out and show you this. Now, you see, in all of this, right? Yes, we had a lot of times where prices were going up and prices were going down and prices were going up and prices were going down and so on and so forth. But you see, the moving average, which is this red line across my screen, basically smooths out price. If you look at this particular point here, prices, the moving average was mostly, flat, basically. But if you look at the overall price action, we had a lot of ups and downs right in the middle of it, right? We had down, we had up, we had down, we had up, we had. Now, if you did not have the moving averages, you may think that, oh, price has been going up and down. But the moving average basically highlights that for you and shows you that, look, it's really been in the range. And truly, if you look at the overall chart in that space, you notice that we've really just remained in one space. So the moving average is one of the ways that it can help you highlight where prices has been. If the trends are moving higher or if it's moving lower, it can really help us see that very, very clearly on our chart. Right? That's one of the major uses of the moving averages, right? But when prices are going down, of course, the moving average can also highlight and show you where prices are going down in that sense. Like in this case, you notice that in this case, price was going down, and of course, the moving average is also showing a downward movement, right? In this case, price was going up, and you can also see the moving average also showing an upward movement. Look at this. Even in this case right here, price is also going up, and you can also see the moving average also showing, that particular move right there as well. So the whole idea is, as a trader, you can basically look at the moving average and it can help you spot if we have a more clear uptrend or a more clear downtrend. If the moving average is facing up, moving higher, of course, it shows that prices are going higher, right? If it's going down, of course, it shows that prices are going down. Now, you can also find this particular moving average on your mobile phone. And when I mean my mobile phone, your HFM app, or even any of the trading platforms that you use, either MT4, MT5, you can also find the moving average right there as well. I'm going to show you. I'm thinking of how I can show that to you without messing up with the meeting that I have. But of course, if you open up the HFM app and you open up the chart itself, right? Just under the chart where you have the different time frames and different settings of the chart, there is a square at the right hand side. is usually the middle of your screen at the far right. Right? There's also a particular, yes, if you click on that particular square, you would also see an F, a letter F, more like a function key. Right there, you can find the moving averages. I'll see if I can show that to you as well before we wrap up the class in this case. But then this is the moving average. Now, how can you use the moving average to spot a trend? It's pretty simple. The moment you see the moving averages showing a particular direction, moving up, like I said, it clearly is a sign of an uptrend, right? If it's going down, it clearly is a sign of a downtrend. Just showing you to show you what exactly was happening at that particular point, right? You can see when it went up, it was an upward movement on the moving averages, tracking what prices were doing. When it went down, it was a downward movement on the moving averages, tracking what price was doing. And of course, when it was going sideways, it was obviously reflecting what the chart is doing. Now, let me clean this up and show you how you could also take advantage of the moving averages and use it to make decisions in the markets. Now, in simple terms, looking at the moving average, right? Think about the moving average as a diagonal, or maybe not diagonal, a more dynamic level of support and resistance. We can take it like that. I'm sure you've learned about support and resistance. For those of us that may not have learned about support and resistance, and you need that information, of course, you can check our YouTube page, HFM Nigeria. We have done a series of videos on that as well. You catch that and watch that, right? Just go to our page and search for entry on our YouTube page, HFM Nigeria. You would see videos. I think we have 2 to 3, maybe even more videos that we have done on support and resistance, high probability entries and exits in the markets, and so on and so forth. Now, if you have your moving average on the screen, you could also use it as a point of entry into the markets. You would notice that price tends to respond at the moving average from time to time. If you look at what I have right here on the screen, you will notice that price responded here on the moving averages as support, right? Of course, as support, of course, as support, right? When price was going down, it responded as resistance. You can see as resistance, right? As resistance. When price was moving up, it was served as support, as support, as support. When price was going down, of course, we also had, you notice that from time to time, we've had a series of times when we had reactions at this particular moving average. And that tells us something. As a trader, you can also use the moving average as more like your own, point of entry in the market. That you have identified an uptrend on your screen, right? And you want to buy. The moving average can serve as that support level where you're waiting for price to pull back before you enter. You notice, oh, price has gone up. Oh, you can see price is going up. It can be a point where you're waiting for a pullback for looking for a continuation higher. That can be a way you can use it. You can use it purely because you just want to spot out the trend and see exactly how the market is moving. That can be a way you can use it. For some people, they can also use the moving average as their own area for setting stop losses. Something like, so I want to buy from here. Let me clean this up so you can see. I want to buy from here, right? From here in the market, right? But for me to set stop loss, I will put my stop loss below the moving average, right? Something like this. Some people do that too as well, right? You could use it as a point to also set up your own, what's it called? Your own area for stop loss in that sense. Maybe not necessarily take profit, but you could use it like that. It depends on what you're trying to pay attention to as a trader. But moving averages can be a very good way for you to spot what the trend is. And it can also serve as an area for entry, looking for pullbacks in the market. Normally, we're used to trading support and resistance of key levels, right? Horizontal levels of support and resistance, right? Where you have something like this. And of course, if price responds a certain way around these levels, it can help. If I want to buy, I want to buy from support. If price pulls back to support, then of course I can buy. If price breaks above support and previous resistance and comes back to retest as support, of course I can also buy. We have things like that, right? Of course, I can sell from resistance too if price breaks through resistance. Let me see if I can extend this a little bit. If price breaks through resistance like this, I can also retest it as, breaks through support rather. I can also use that previous support, now turn resistance, and I can also sell. You could use it that way. I'm saying that in the same way, you could also use your moving averages for the same thing. Let me draw it up and show you what I'm saying. So let's say we have a moving average on our screen. Excuse me, draw this up. All right. Let's say we have a moving average on our screen like this, right? You could also use it as your own entries as well as your own level of support and resistance. If price breaks above the moving average and comes back to retest the moving average, then I will buy. If price breaks below it, of course, now sellers are more in control, right? And it retests the level, of course, I want to sell and I can sell. So you can use the moving average as a way to even know where you're entering the market, apart from spotting the trend. Because don't forget, you're buying at a lower price, like what we have right here. That you want to buy does not mean you should be buying from here, right? You're looking to buy at a lower price. That you want to sell does not mean you should be selling from the low point. You're looking to sell at a higher price. So the moving average can serve as your own dynamic area of support and resistance, and it can help you make decisions as well on your particular trading platform whenever it is that you're trading. Right, of course, like I said, the time frames are also important, but it's important that you as a trader should also be, flexible with it. There are different ways that different people use moving averages, and you would hear where, a different trader would have a different number or period he uses, a different method for it, and a different, apply in terms of what price he's trying to apply it to, right? But like I said, from the very beginning, you could use a simple moving average. If you're on the shorter term day trading perspective, of course, you can use the 50 simple moving average. Some people use 30 in some cases. You could use that, right? But make sure you are consistent with it. That's the thing. You should not just be trying all manner without giving at least one of it enough time to manifest or at least show in your trade, right? So if you're choosing to use the 50 simple moving average, please use it a bit consistently. If you're choosing to use the 30 simple moving average, please use it consistently. If you feel like it's the exponential you want to use because it, of course, pays more attention to the more recent prices in the market, then by all means you use it. But under no circumstance should you try, particularly at the beginning, when you're just trying to figure it out, to be, moving through different ones, changing this, changing that, without really giving yourself enough time to figure out which one works best for you or not. I hope that makes sense. So the moving average tool, in very simple terms, is a tool to help you identify the trend, a tool that can help you with entries and exits in the market, a tool that can also help you determine where you want to put your stop loss. Take, for example, look at this particular price action. Now, first of all, whatever technical tool you're using or indicator you're using, you must understand that, of course, it's not the only tool in the market, right? It's not the only reason why you want to be in a trade or not. You want to make sure that you also have the analysis done already, right? To also help you with that. This particular chart, let's see, is still ranging for now. Let's move down to a different time frame, just as an example to show you how I could use this in real time. So now let's say I want to use this particular moving average to place a trade, and I can see clearly that prices are trending, moving high. One thing I can look out for, I can notice here is, of course, every time the price came close to the moving average, it didn't test it here, but came close to moving average, its price moved high, right? Came closer here as well. And of course, an instrument like pounds JPY has been weak forever, right? This entire week. Today is the weakest currency. Today is 18th of July, 2025, the weakest currency, right? This week is also the weakest currency this week. Even this month of July is the weakest currency this month. So of course, that's why you're seeing that prices have typically been going higher more on this particular instrument, right? Now, but let's look at this. Let's say you have done your analysis, you figured out what you want to do to that particular instrument, and now you're here and you want to place a trade, right? Using purely simple moving averages like this, right? You could simply say that, oh, if price pulls back to the moving average like this, then I will buy from them, right? Whatever the price is at that particular time, I will buy from there clearly. So if you're looking to buy from somewhere like this area, if price pulls back there, right? As long as price remains steadily above the moving averages, then the buy bias I have is still intact. That can help you as well. And it could also help you nullify a trade that you feel may not be going well anymore if price starts to move the other direction away from the moving average. right? So you're buying if price breaks below the moving average and continues going downwards. That could be a sign that, look, I probably should not be in this trade anymore. This particular signal that I have is failing. It could be a sign like that. So as a trader, you can pay attention to this as well to help you, right? And if you decide that, oh, look, right, if I'm entering from here, my stop loss should be set below the moving average. Now, you could look out for how many pips below the moving average. I prefer to use the previous level support and resistance, horizontally to select stop, what's it called, stop loss in that sense. But it could also help you. But the idea is it helps you identify the trend. It helps you find entries by using it as a dynamic area of support and resistance. And also, it can also help you manage your risk in terms of where you should put your stop loss in that sense. This is just one side of it. The other side of it that I also want to highlight to you is what we call the Fibonacci tool. Now, the name doesn't sound English, but in very simple terms, let me show you exactly, what I have here about the Fibonacci tool. I just put this up very quickly. Let me see if I can trading with the Fibonacci. All right, so we could do that, right? Just to keep it very simple, have like a visual, because I must make sure that I'm not keeping us too much. I want to keep to our time and make sure that our time is well spent in this particular class. So now look at this. What exactly is the figure? I just put this note up to just quickly give us an idea of what we're working with so that it's easier for us to take notes of how we're going to use this or work with this. Now, the Fibonacci retracement tool is a very, very, very simple and yet effective tool as well, right? It's a very simple and yet effective tool. The idea is, yes, you need to trade, follow the trend. The trend is your friend, blah, blah, blah. We agree with that. But the problem is, even in a trend, right, you don't want to buy at the high price. You want to make sure that even if we're in an uptrend, you're trying to buy at a lower price. It's usually more cost effective, more reasonable to buy lower because, of course, price has a higher probability of going up from down. You get to enter the market at a good price, right? You don't get to suffer through too much drawdowns. So now that we have said that, the Fibonacci, yes, there's a mathematical, way to use the Fibonacci sequence. There was an Italian mathematician many years, decades ago, right, called Fibonacci, and he was the one that came up with the Fibonacci sequence. But we're not talking about mathematics today. We're just going to focus on, the tool here in our trading, how it helps us in trading. And I said traders can use the Fibonacci retracement levels, right, to find possible support and resistance areas as well, right, on the chart. The idea is you want to see areas where price can bounce from going higher, areas where price can retrace from, or areas where price can even stop in that sense. It's still about support and resistance, but now we're using or applying a mathematical principle to it. And I put a simple rule here, 4-step process where prices or what you can help you with prices to see how you can use the Fibonacci retracement tool. I said, number one, you want to look at for a trend. Of course, you use Fibs where you can identify trends. So that's why it's possible to combine the Fibonacci with the moving average, right? But you can use it individually as well. You need to identify a trend. When you're able to spot a trend, either prices are going up or prices are going down, then you can apply the tool. Let me show you very quickly. Instead of reading through this, let me just show you visibly on the chart because of our time so that we do not waste time and we are more effective with this. Now, look at this. So we're able to identify this particular, so let me take out the moving average. All right, so we have this. And we can see prices moving up. Let's just say from this lowest point to this highest point. We've clearly seen that price has literally gone up from here to here, right? Now, we're seeing an uptrend. Of course, the moving average also showed us an uptrend, and we want to buy, but we don't want to buy at the highs. We know that prices oscillate. That is, when price goes up, price breathes lower before it continues higher. more like a staircase movement. Typically in market, this is what price movement looks like, right? It not just never moves in a straight line. You have ups, you have a breather, you have a continuation, you have a breather, you have a continuation, right? You have a breather. Sometimes the breather goes longer, right? And then of course you have a continuation, you have a breather. This is how trends are formed, where we have higher lows. The next low point is higher than the previous low. The next low point, literally, is higher than the previous low. The next low point is higher than the previous low. And the highs, we have higher highs, right? The high we have is higher than the previous high. The next high we have is higher than the previous high, and so on and so forth. So the idea is this is how prices move in staircase movement. So now that you've also identified a trend like this, you don't expect that price to just be going straight up like this. You said that when it goes up, it can break lower, continue higher, break lower, continue higher, break lower. You want to now know when it goes up, where can it stop by breaking lower? As it's coming down, at what point is it likely to stop for you to be able to enter to buy before it continues higher? That's what you're looking for. You're looking for these potential areas where price can retrace to before the continuation higher can happen. This is where the Fibonacci tool helps you. The idea is if it's an uptrend like this, you can pick the Fibonacci tool and draw from bottom to top, from the low point to the high point. Let me write that out for you very quickly. In an uptrend, draw the Fib from the low point to the high point on the chart. Right? In a downtrend, draw the Fib from the high point to the low point on the chart. So I'm going to try that out very, very quickly. I'm going to show you exactly how that works. I hope you're following me. Where do we find the Fibonacci tool as well on our computer? Now, for me, the Fibonacci tool is right here at the top of my screen here. If you can't find it here, if you go to insert, you just see Fibonacci there itself. There are many, ways to use the Fib, but I'll tell you, I have never used any of the other ones. The only one I've ever used is the retracement. And that's what I'm referring to when I talk about Fibonacci here. So the retracement, when you pick it, this is what it looks like on your screen. You see, my cursor already has it there. Because this is an uptrend, let's first use my drawing to do it so I can show you what I'm referring to. Right? Because this is an uptrend, I can simply pick it from the lowest point and drag it to the highest point. Oh. I just did it on my own drawing on my own screen, right? The idea is you notice that it prints or it starts to show us different price options here. 23.6, 38.2, 50.0, 61.8, and there are many more as well, but these are like the most common ones. Let me clean my screen. I think my screen is a bit too busy. Let me just clean it up a little bit so that we can. I think I can put this one up in the chat box in case you wanted to see that later on. You could get that information right there, right? So I can clean it up. Let me just clean up my screen so that it's not too busy, and of course we can still continue enjoying our conversation. Now, of course, you look at the Fibonacci and you notice that it has different options there. It has the 23.6% retracement level, 38.2% retracement level, 50.0% retracement level, 61.8% retracement level. The idea is prices in this uptrend can either pull back to 23.6 or pull back to 38.2 or pull back to 50.0 or in some cases pull back to 61.8. The idea is generally these levels are areas where price can potentially pull back to before continuing higher. That's the idea. So if you want to buy, you can look to buy from 23.6, a pull back to the level, or from 33.2, or so on and so on and so forth. Now let's apply it really to the chart properly and see how that looks like, or how that works on an actual chart. So back to this, our little uptrend that we have here, before we look at other charts and see what we're talking about. Back to this, our little trend up here. We can pick it from the lowest point and take it up to the highest point and see that in this uptrend, having known from our analysis that we are supposed to be buying pounds JPY, in this particular case, at what point can price pull back to before it continues going higher? So let's pick the Fibonacci tool, insert Fibonacci retracements, right? From the lowest point, I'm picking this lowest point. The choice of the lowest point is also very discretional for you as a trader, right? You could choose to use any of them, but the lowest point you can see can also help you. Now, this is how I use it, right? I pick the low point here, and of course, I select hold it. Since it's an uptrend, like what I told you, you're dragging it from the lowest point to the highest point. Just by putting this on the screen and looking back a bit, you would notice that at every junction, when price broke above these levels, price retested these levels on its way to the upside. We had retest here, we had retest here, we had retest here, we had retest here, and so on and so forth. So the idea is, even in hindsight, I know this is in hindsight, but just to give you an idea that prices typically tend to retrace to those particular levels and can provide you with upsides, potential upsides in the market. It still serves as areas of support and resistance. If I still want to buy this, I can expect price to pull back to this level, and I choose to buy from here, expecting this to happen, to continuation to happen in that same sense. I can use it to also anchor my stop loss, that if I'm buying from 23.6, for example, right, I want to hide my stop losses under 38.2. You could do that. You could say, I want a deeper correction and I would rather price pull back to 30.2 before I buy. You could say that. The whole idea here is to be able to use these particular tools for entries, potential entries into the market, and exits too. Fibonacci tools can be a very great way to see exactly what the trend looks like, and of course, know where it is that you want to step into the market doing. Now, let's just try a couple of other charts and see exactly, what we're doing, and use the same Fibonacci tool to see if we can identify the same things that we've been talking about, that we can identify. So now let's look at this. So price went up. Look at this. Let's just pick this. Let's assume that on the day we got to the market to trade, we were here, this high point, on the 9th of July. This is where we were. We hadn't seen the rest of this. We had not seen these. And we felt like, look, price should go up. And we want to know at what point you should be buying from. Now, we're going to pick a fib, for example, and we're going to pull it up from the lowest point to this highest point. You would notice that price came down. Now, in this case, 23.6 did not hold, but you can see that 38.2 held pretty clearly. And you notice that quite a number of times, price came back to that particular level and it went up from there. So that means that on this day, on the 7th, if you had pulled your Fibonacci from the lowest point to the highest point, you could have waited for price to pull back to either 23.6 or 38.2 and placed your buy trade there. And you could have bought from somewhere like here. That's if you know you should be buying pounds JPY in the first place. And of course, price would have gone up in your favor as expected. And you have been able to have bought from a very good price, making at least 170 pips on that particular move. Compared to if you had just said, oh, price was going up and you just bought here. If you had bought at the high point, you would have suffered drawdowns, all these losses of about 170 pips, you will have been suffering it. And eventually, if you still stayed in and waited all along, perhaps you'll have been lucky for price to still just, after about how many days? Since the 9th, today is 18th, basically 9 days after, almost 2 trading weeks, right? You would have, after waiting all this while, you would just be breaking even today. But you see, the fib could have been a better tool for you to spot an entry into the market and, of course, make a decision. I hope I'm making sense and I'm communicating with you. If you try to look at this on a different chart completely as well, and you say, oh, okay, let's assume that on the day we wanted to trade, right? This was a day at this point, price was up here on the 3rd of July. And I wanted to know where prices could pull back to before I make an entry. And I decided to pull my fib from this lowest point to this highest point. You will notice the same way price would have pulled back to 38.2. Can you see it? And of course, price would have continued higher from there. And you could apply this to, this is for an uptrend. Let's try it for a downtrend. Let's find an instrument that has been going down and of course identify a, the trend like that. Let's just find one. I'm just going to open up a new instrument. Let me clean this up and show that to you before we go. All right. So let's say we have an instrument like, say, AUD USD. All right. So let's look at this particular chart. So let's assume that, oh, we wanted to sell this instrument, right? The day we came to the market was on this day when we are this high on the 11th of July. And at the time we're talking, we're currently maybe at this lowest point. I wanted to see price has gone down. We're identifying a downward movement. We wanted to sell, but we wanted to know where price can pull back to before we continue selling. The flip can also help us. But because it's a downtrend now, we're pulling back from the top to the bottom. Can you see it? In this case, price first pulled back to 23.6. Assuming, well, maybe you see it better. Right? Price first pulled back to 23.6 before continuing lower a little bit, but you didn't hold. Eventually, it was 61.8 that held, and price went down. If we say, oh, okay, we want to look at other price data and then extend this time to maybe this particular day, and then we move the moving average down as well. You'll notice that price pulled back to 23.6 and went down. I think we had a particular data on this day. There was a spike, but when price got to 50.0, of course, price continued lower. So my point is, you can still use the Fibonacci levels for your own entries and exits in the market. But which of the levels should you now use? There are plenty of them. We have 23.6, we have 38.2, we have 50.0, and we have 61.8. Which of them should you really use as a trader? Which of them should you really use as a trader? Now, I think that for every trader, you've got to understand that, look, it depends on what you're looking out for. But sometimes markets may respond with 3.6. Sometimes it may be 38.2. Sometimes it may be 50.0. So you have to, I think from the beginning, choose one particular or two or three particular levels that you are constantly paying attention to, right? Because what if you say, oh, it must be 23, and then today is 38.2. So you've got to choose a particular level that you want to stick with. If you ask me, the levels I like best are 38.2. I like the 38.2 retracement level a lot. I like it a lot. Usually, when I'm trying to trade, that's the level that I'm looking out for. Either 38.2 or 50.0. One of those two, or anything within that range, is what I'm personally looking out for. I'm typically looking out for levels around pullbacks to those levels for me to pick my entry. Yours may be 23.6. But sometimes, if what I am looking for, maybe what I'm trying to trade is a very, very, very fast moving catalyst. Something just happened, prices are moving well, in that particular space, then I can also follow the same route. I could also do the same thing. For me, what I'll be doing is I can now modify and start using 23.6 as my own area that I'm looking for a pullback to before looking to continue higher. It really depends on what you're trying to pay attention to as a trader. But the Fibonacci retracement tool can be a very, very, very good tool for you to be able to identify areas where price can pull back to, breakouts and retest, and of course, continuations right there on the chart. I hope you understand what I mean when I talk about the Fibonacci tool as well. So in all, right, the moving average and the Fibonacci retracement tools basically help you identify trends and areas of entry into the market. You can know exactly where you should or you will be stepping into the market from, and you can also pay attention to it right there on the chart. It helps you spot entries. I think I put a few things on the list, right? How to use the Fib retracement tool. I said you look at a strong move either up or down. Sometimes you identify the trend, prices have gone up or down, and you draw the Fibonacci tool from the start of that move to the end of the move. So if it's an uptrend from the lower point to the highest point, if it's a downtrend from the highest point to the lowest point, right? When you do that, of course, you pull the pool, and once you pull it, you can see the different levels: the 23.6 level, the 38.2 level, and the 50.0 level. Right. And of course, those levels can now help you see, help you, understand. I want to use guess. Let me change that. Help you predict. As that will be a better use of English there. Predict where price can pull back to before continuing, right? Like I said, some of the benefits of it is helps you find entry points when you're trading, looking for pullbacks. You know you want to buy, it's an uptrend, you've identified it, but you don't want to buy at the high point. You're looking for pullbacks and retracements. It helps you with that, right? It also helps you, find areas for taking profits as well. Like I said, it also helps you with exits. You can also anchor your stop losses using the levels like I showed you, or even look for targets using the levels like I showed you. I hope we understand this, right? Our time is running. Let me just really make sure that I do not miss out on any of the questions before our time is completely out, right? Let's just see that now. Let me see. I have quite a number of questions here. Let me see which of them is okay. Let me just run through them very quickly, guys. This one is saying that. All right. Let me see. I'm trying to find. All right. I saw a message. Okay, let me just see if I don't want to miss out on any of the messages. All right. Um, How does one reduce the size or increase the size of the candlesticks? Well, I didn't do much on that. I just basically zoomed in and zoomed out on the screen, right? I didn't really do anything out of place. I just zoomed out. You can right click and go to zoom in or zoom out, right? By zooming in, of course, it looks like it's now bigger. So that's what I was doing. Now zooming out, of course, I have reduced that. So there's that. And this other one says, trying to make sure I don't miss out on anything. Is trading on weekend not available again? Well, the Forex market is not opened over the weekend. So you cannot trade Forex over the weekend, right? It's never been opened over the weekend and it's not starting now, all right? Does that mean when someone asks me to enter 50 EMA? Yes, of course, EMA stands for exponential moving average, all right? Are moving average formed at the same time the candles are formed or after the full formation of the candle? Now, the moving averages are always there from the past, right? But as new candles are being formed, the calculation is added to the previous existing calculation and the moving average is extended. For example, in this our case, we are applying the moving average to the close of the candle. So it's when the candle closes that our price that it closes is added to the average mean that we have been using, and the moving average is extended. So it basically tracks price. Price closes, it extends. Price closes, it extends, and so on and so forth, right? Someone saying, thank you, sir. Are we going to have a replay of this? Well, we'll see how we can make the video available on our YouTube page. You can always catch that there. Please, you in person, which one do I use? Simple moving average or the EMA? And what is your moving period? I think I already mentioned. I said personally, I mostly use simple, except maybe if I'm using the momentum strategy where I can add a 9 EMA. But typically, I just want to know what the overall trend is or just see what moving average is saying. I use simple moving average. And if I'm looking at sentiment-based trades, right, I look at 50. Sometimes I look at 30, but that's where I stop. But if I'm looking at a more, longer term trade, of course, that's where I pay attention to sometimes the 100 moving average, sometimes maybe even higher, right? It depends on what I'm paying attention to at that particular time. But that's exactly how I go about it as well. Where can we get these tools on our mobile phones, right? I mentioned it already. On the HFM app, you can find the moving averages on the chart. When you expand the chart, among the options there, you have moving averages there as well. Mr. Stephen is asking that when you say lowest to highest point, right? Are you taking it from the candle wicks or on both ends? Well, I mean, you can use it from the wicks. Look, at the end of the day, when it comes to pricing, the market is not perfect. So, and support and resistance areas, let me add this, are more zones, not necessarily a single line or a single price line. Typically, I pick it from the lowest point I can see, which typically is the weeks, the end, the last price, the highest price, and the lowest price on that particular sequence, right? But you can also modify, be a bit more flexible with it. It's just an area, it's not a line. So you can be a bit more flexible, with that as well. Just to make sure I answer. Emmanuel says, I'm just joining. I want to know if Fibonacci is time frame sensitive. Yes, we discussed that already. Yes, it is time frame sensitive as well. Let me see. Oh, I think I've been talking about these ones long before now. What is the difference between a pullback or a retracement? It's just different language for the same thing. It's the same thing. Retracements, pullbacks mean practically the same thing. All right. Will the session be uploaded on the HFM Nigeria YouTube channel? Yes, it will. It will be uploaded on the HFM Nigeria YouTube channel. Right. Can you use the Fibonacci to spot support and resistance levels? Of course, Samuel. Yes, you can. That's what we've just tried to show us right here on the screen. Let me see. I'm trying to look for questions that are relating to what we just talked about. Right. Yes, it was a moving average that I used the 50 SMA to work on. Our time is really up. We can't really stay and hold us longer, than I can right now. Let me see. For those of us that are saying, oh, review, some of these questions are things that we've already touched in today's meeting. So it's okay. You could always recatch the video. It will be posted latest today on the HFM Nigeria YouTube page. So guys, we can always catch this. Just search for the topic on the YouTube page. You would find it. And of course, you can see it there. For those of us that have, maybe while you're watching the video, another question comes up and you feel like, oh, okay, I want to ask this question, or this question comes up, I want to understand what's being said here, and you want more information on that, you could as well just reach out to us, either myself or Emmanuel, any one of us, right? And of course, we can attend to your questions individually here as well after the class if you have watched the videos and you have subsequent questions after that. But guys, I want to say thank you to everybody for being a part of this afternoon. I mean, it's just been 1 hour, short past our time into this class. We have to go prepare for the next webinar as well. We just try our best to make sure that HFM, we're consistently trying to pass information across to you that helps you learn, grow, trade, and make profit for yourself. The idea is to ensure that you're well equipped to make informed decision in the market. And all our past webinars and past videos and seminars and events are all available on, our social media, particularly our YouTube. You can always catch it, watch it, reach out and ask your questions. Thank you so much for being a part of this. I'm going to call it a day at this point. Do enjoy the rest of your day. Enjoy the rest of your weekend. And of course, have a fantastic time. Take care of yourself, and it's goodbye for now.